Hey, good afternoon, everyone. Thank you for coming to the webinar. I think you're going to find that I have a lot of really interesting information to offer you today regarding options. And just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. And I began trading the futures and Forex markets about 10 years ago. And my area of major expertise is that of in the optimization of software systems, specifically optimizing multivariable equations like that describes the movement of price in a financial market. Now, we started an options newsletter about 6 months ago, and it's been extremely successful, really based off of a technique that I really have developed. Now, it's not a new type of options play, but all the components to it, I think, create a little bit of a unique strategy. Now, before I talk about that, what I wanted to go over was some of what I do in order to determine which options picks go into the newsletter is I have been prescribing to a number of the premium options newsletters. I like to see what they're doing. I never involve their options choices in the options newsletter, but I like to see exactly what they're picking and why. And I think it's really important to find out what your neighbors are trying to do, what they're trying to accomplish, and how they're trying to get there. So what I thought I would do first was to show some of I haven't cherry-picked these, and these come from a couple of options newsletters. They're extremely expensive. All of the recommendations are made by major options gurus, and I just thought I would review some of them with you and show you exactly where they go wrong. Why you have to be very careful. I mean, when you pick an option, and I think it's really important to understand all the mechanics that go into choosing it, not just get a recommendation and then you mechanically place it. Now, here's the first options choice that I'm going to show you. The pick was made on December 4th of 2014, and this was the rationale for picking. The news was that most employment numbers came out solid today, which almost guarantees that the Federal Reserve will hike interest rates at its meeting on December 17th and 18th. Now, the reason I picked it is that's exactly what they did. Now, in the past, gold has sold off after a threatened rate hike, and it looks like the market believes at this time there's going to be a hike, and there was. That said, it looks like that gold has fallen too far, too fast. Now, the first reaction to a Fed action is usually wrong. So the bet today is that Newmont will reverse and sell off on Monday. So the recommendation was to buy Newmont puts. The price was 28 cents. The stop loss was at 20 cents. So there was a pretty tight stop. The price target was 65 cents. Now here is the chart that I stylized that came out with the pick. Now basically, because there was an anticipation that Yellen was going to raise rates, gold and Newmont Mining as its proxy was heading up hard. And this options picker was saying that Newmont had come too far, too fast, And so the recommendation was to short Newmont or buy a put. Now, let's take a look at what happened. December 10th, 2015, there was a recommendation to exit the puts. There was increasing signs of deflation, and the export and import numbers suggest that the Fed may not raise interest rates. It's time to sell the bearish bet on Newmont mining. Newmont last traded for 32 cents for a marginal gain. Now, here is the technical analysis of the options picker. And I don't want to make this too complicated. Newmont's a little bit of a complicated pick, but you can see it's very rudimentary technical analysis. And I think that you have to be a very, very good technician in order to pick stocks. The MACD isn't even alluded to here. The volume is not. You can see there's a MACD crossover, and Newmont's heading up. Basically, you're shorting a stock, and you're taking a counter trend position. But what we have to do is take a little bit more of a detailed look at exactly what was going on with Newmont. Now, in no way am I trying to sell you right-line software, but I want to show you what right-line. Now, ignore the quant lines because these are stocks, and we just developed quant lines for stocks. At the time that I had the quant lines here, these were our future. These were the futures quant lines. Basically, you were recommending to buy a put on a stock that was in a firm uptrend. You can see that it was above the 50 and it was above the 15. And basically, the trade was closed here. Leo, they can see my pointer, can't they? Okay, you can see. I just want to make sure you could see my pointer, and you can see that you really, really got crushed on the stock. I mean, on the put. That Newmont, even though there was anticipation that it had come up too far, continued to really dramatically move up, and you were way, way out on Newmont. But then eventually, Newmont Mining came back, and the trade was closed right here for a very small gain. And you can see that with time erosion from 12.4 to 12.11 or 12.10 when the trade was closed, even though the underlying stock was trading a little bit higher, you just got a small break even. Now the point of this is that the put was recommended to be closed just at the point when Newmont was truly breaking down. The 50 had rolled, and you had broken below. So now this is the first time that you were really in a bearish position. You could see that the whole 50 had started to come down. And that's exactly what happened. And Newmont collapsed. So if you simply would have followed the technicals on Newmont, you would have wound up making a significant amount of money. Now, the expiration on Newmont, I think, was the 16th. And Newmont would have been considerably in the money. This is the 15th. You would have been way in the money at the time that Newmont was closed. Now this is from a guru, and this is just selling a naked, or just buying a naked put. And we're going to look at one more. We're going to look at a few more, actually. This is a call to buy Nordic American Tankers. Now, it's a company that owns oil tankers. While the rest of the shipping business is sinking, oil tankers will do well in the future. The reason is simple. When oil is cheap, people use more of it, and more of it flows around the globe. The January recommendation was to buy the January Nordic tanker calls. I don't have the price. It's really irrelevant. Now let's take a look at the technical analysis that's performed. And again, what I did was I just put this in barcharts.com just to give you a very rudimentary understanding of what they were looking at with the technicals. Now, basically, the MACD has still turned down. And the stochastic is not oversold. It's almost right at the 50 line. So there's no technical indication here to buy Nordic Tanker. Now, Nordic Tanker has broken below its 100-day moving average. It is sitting close to its 200-day moving average, and it's pretty close to a doji. But if anything, Nordic Tanker looks like it's going to break down further as opposed to move to the upside. I mean, there's nothing here that I see that would lead me to believe that Nordic Tanker was going to go up based on technical analysis. Now, on fundamental analysis, if you think that the cheap price of crude is going to lead to more usage of oil, then it might be a good opportunity to buy it. The problem is that when you make an assumption like this and you buy a call based on an untested hypothesis or an untested hypothesis, basically what you're doing is you're taking a roll of the dice. If people buy more crude, then and they buy more shipping, the Nordic Tanker will probably rise. If they don't, Nordic Tanker is going to fall. In terms of analysis, Nordic Tanker is going to fall. Now, the analysis here, the MACD hasn't turned, but they call the RSI undervalued, but it is not oversold. There's a doji forming at support. This is bullish. Buy the Nordic Tanker January 16 calls. Stop losses at 30 cents. Now let's take a look at Nordic Tanker. Here's where the calls were opened. Again, this is Right Line Software. Now Nordic Tanker the calls were opened right here. And Nordic Tanker was in a strong downtrend. Now, luckily, it did come up, but you can see that Nordic Tanker was just in chop. And it went from a downtrend, broke back up, and then just really broke into total chop. There was no trend on the underlying stock. And really, there was no way that Nordic Tanker should have even been looked at as an options call. Now you can see that Nordic Tanker, now it expired right here. And so if you did take the stop, you were closed out of Nordic Tanker at 20 cents. If you didn't stop it out, then the Nordic Tanker expired worthless. But you can see just by doing an appropriate technical analysis, you can see that there's no way that Nordic Tanker is an appropriate stock to look at as an underlying vehicle to create a call position. Let's look at another one. Now, this is not the same options guru, and I just want you to know I am not cherry picking their trades. This is the kind of fundamental and technical analysis they do. It's very, very rudimentary, and it leads to a lot of losses. This is why I never take their picks. Here's one on August 11th, 2015. Now, the Chinese devalued its currency, the yuan, in order to boost exports, and it did do that. It dropped the yuan by 1.9%, the biggest one-drop day in a decade. American Eagle Outfitters buys its merchandise from overseas factories. However, 87% of its stores are in the USA. So American Eagle Outfitters is going to benefit from a rising dollar and a falling yuan. Excuse me. And it's also well timed as it is back to school shopping season, a time when clothing retailers generally do well. Again, they're making a supposition, and it's an untested hypothesis. Now, first, let's look at the technicals on American Eagle Outfitters. This is just the very, very simplified technicals. This is all that's been used as a technical analysis to decide to buy AEO. They're making the assumption that the doji is a continuation pattern. That's it. Now, American Eagle Outfitters is not in an uptrend. It is consolidating laterally. And it's been consolidating laterally, made a move up here at the beginning of July, and then it's been in a consolidation pattern, a very tight price pattern, for almost a month. And they're calling this a doji, a continuation long pattern. I mean, this is really, really poor technical analysis. Now, here's what we see. Now, right here is where American Eagle Outfitters was picked as a long. You can see the arrow. And on the call, and on that information, AEO did shoot up. But if you didn't take your profit quick, AEO just collapsed. And look how far down it fell. It even gapped down, all the way down here. Now, once American Eagle Outfitters broke below the 50, and you could see the technicals of the underlying stock, the position should have been closed. You just don't let it run. Now, you do have a stop at 20 cents, but you can get out of it a lot quicker here, almost at break even, if you simply watch the technical and watch the technicals of the stock. And then it just breaks down, and you're either stopped out or it expires worthless. Here's where the stock closes at expiration, lower than where it was at the initiation of this options position. All of this could have been read with appropriate technical analysis used to manage this call. Now, this call also is it's one of the few that I've seen that was actually placed in a position where American Eagle Outfitters had a shot to go to the upside, and it did. There was a catalyst, and the catalyst, the devaluation of the yuan, did shoot AEO up for a few days, but then AEO just totally collapsed. You could have caught the collapse early, and actually, this was a tremendous C candle and an opportunity to sell, to buy a put on American Eagle Outfitters and to make a significant amount of money, to go counter trend to what the guru was talking about. Let's look at another pick. And the reason I'm doing this is I want to demonstrate to you how poorly the picks are created, how rudimentary the technical analysis is that goes into the into the work to decide on buying this position, and what a tremendous supposition is made as a reason for taking a position on a given option. Now, this spans a couple of really supposedly high-powered options newsletters. Now, here's a report on Nike. Now, I think if you remember, on May 28th, 2015, there was a big FIFA bribe investigation. And this is taken right out of the newsletter. You know, FIFA is the governing body that represents soccer. The Swiss arrested a number of members of FIFA, or FIFA, I don't know how it's pronounced, and extradited them to the U.S. The CBS News report showed what a major deal this was. You know, Nike is a major, excuse me, is a major endorser of the FIFA games. So this supposition was made that if FIFA came under scandal, that Nike was going to really hit it hard. Now, when Walmart Mexico was caught in a bribe, now I looked at this Walmart Mexico deal. Walmart was an integral part of the bribe. In this particular case, Nike had nothing to do with the bribe. So Nike lost Walmart lost 30% of its share back in 2012. They didn't do appropriate due diligence. Part of it was that Walmart was involved in the scandal. And Petrobras also was intimately involved in the scandal. Nike had nothing to do with the scandal. Supposition made that Nike is going to drop fast based on the FIFA scandal. Now here's the technical analysis. Now they've thrown in a Bollinger Band. We have an MACD crossover above the zero line, which is bearish. We know about the move, and we know about the fundamental analysis that Nike is caught up in. It really isn't caught up, but it's associated with an institution that may be caught up in a bribe. So the real move on Nike supposedly is going to be news driven. So your recommendation is to buy a Nike put. Now we can see just from this crude chart that Nike's in a strong uptrend. Now let's take a look here. Now Nike, the order was placed right here. Now you would never buy a put on an instrument that sat above the 50 and above the 15 on our software. It's buying a put into a stock that's in a strong uptrend. And then you're making the supposition that Nike, that has absolutely nothing to do with the scandal. I'm sorry, it's right here that's purchased. Right here. Now, its exact position is really unclear. It's not a stock that we would look at an underlying that we would look to purchase an underlying option on. It really doesn't have a defined uptrend or downtrend. It's really in a chop zone here. And what did Nike do? It just simply went straight up. And you either got stopped out or you wound up with a trade that was worth nothing. Bad technical analysis, erroneous fundamental analysis leads to loss after loss after loss. Now, the most important takeaway, I'm going to show you one more, is not that these particular trades failed, but the way that the style that's used to make these picks is flawed. The technical analysis, again, is rudimentary and poor. And the fundamental analysis is all based on supposition. And if the supposition doesn't play out, you get killed, because oftentimes you're asked to buy a put on an uptrending stock or buy a call on a downtrending stock. Now let's look on July 23rd, CBS Corporation. CBS is a $26 billion entertainment company with a P to E of 10. It beat earnings in February, and it launched. Strong earnings in May, and sold off. Now they're deciding that the sell-off is overdone. So it's reporting earnings on Wednesday, and the supposition is made that the share price will rise into earnings. And then the plan is to exit right before earnings. The chart, which we're going to look at, shows a sell-off into support going back 9 months. There are 3 dojis in a row with a MACD crossing below the center line. The stock is well below the 200-day moving average and looking for a positive catalyst. So they're even telling you the stock is in a downtrend. Simply the fact that CBS Corporation is moving into earnings is going to be enough of a catalyst to provide you with to buy a call. The call's at 50 cents, stop is at a 50% loss. Now here's the analysis on CBS. You can see the circle I put here. You have this MACD crossover way below the 0 line, and the tremendous downtrend that CBS is in. Now there's no evidence that it's consolidating at 54, and it could drop all the way down to just above 48. I mean, basically, this is a stock I wouldn't touch in terms of buying a put or buying a call based on technical analysis. And this is what you need to do if you're going to make your own options picks and publish them in a newsletter. Now we take a look at where you were asked to buy the call. Now here the stock is in a clear-cut downtrend. You're below the 50, you're below the 15. It tries to rally, and then it breaks down. It tries to rally, it breaks down. It tries to come back, it breaks down, and then the stock just completely collapses. And there's expiration. You either were stopped out or you lost the position with a 50% loss. So you can see that the picks are pretty awful, and these picks come from 2 of the best options newsletters supposedly that are out there. They have a lot of subscribers and a lot of people who pick these stocks and pick the options. Actually, who pick the options based on these stocks really got beat up. So what I did was I looked at a better way to create an options newsletter. Now, when I first started it, we came up with a lot. I came up really with a lot of winners, doing exactly the opposite, paying close attention to technical analysis, not trying to come up with a major fundamental analysis theme, and we came up with a lot of great winners. American Eagle Outfitters made us 150%. Southwest Airlines made us 67%. AEO Smith made us 88%. Sonic, the hamburger place, made us 85%. And then we started to hit some trouble. I bought Groupon, and it was a 76% loss. Technicals were great. The fundamentals, so-so. I bought Alcoa, just bad timing. I mean, I have a live chart of Alcoa up right now. That's off the screen. Alcoa is screaming. And then we bought Foot Locker, made nice money on it. We bought American Eagle Outfitters again and made nice money on it. But I just thought that there had to be a better way to pick options than this. So what I did was I created my own menu and my own formula for picking options. And since that time, we have taken. Now we still in the options newsletter, based on a lot of technicals and to a lesser extent the fundamentals, we still do buy naked calls. Costco we purchased, but the the position that I'm talking about, we've taken 11 positions. We have 9 winners, and we have 2 positions that didn't provide us with 100% of our potential profit. And I'm going to show you now some of those positions. Now, this is rig, Transocean Offshore. Now, I only provided you with a very, very rudimentary open, high, low, close technical, because the formula that I use in order to make these picks is really quite different than anything else that I think you may have seen. Now, the options position on rig, it was a September 16 open on rig. You can see that rig is in a strong uptrend, but all rig had to do was close above $9 to return to us 100% of our, to give us 100% of our potential return. And rig never even came close from September through December 16th to approach that $9 line. And depending on how much money you committed, you made 100% return on your investment. Now, I'm not going to go into the fundamental analysis of Transocean, but at the time, I just believed, from what I had read, and I do a tremendous amount of reading, that the that the drillers were way oversold, and in addition, part of the formula I use told me that Transocean Offshore was going to rise, and it did. Rose very, very nicely. The next pick was Sun Edison. Now you can see where the position was placed. Again, here is where I did pick a bottom, but I had strong evidence that Sun Edison had bottomed. Now, all we needed to do was to have Sun Edison close above $8. Where did I place this here? No, it was $7 for us to get 100% of our potential return. And you can see, based upon the evidence that I had, Sun did make a nice run up, made a run all the way up to 12. The problem that Sun had, and this is part of managing the position, was that Sun ran into legal problems, just like it did yesterday. Sun dropped 20% because a class action suit was filed. Well, legal action was brought against the company, things that we couldn't foresee. It pushed the company down right to our level. It still pushed up again, and then we were able to close the position out with 100% return, or 100% return of our potential investment. Now, another position we took was Gopro. Now, Gopro at the time I placed the position right here. Now, I believed that Gopro was going to continue to fall, but the analysis of the position gave me to 25 for us to collect 100% of our potential investment. And you can see that Gopro did fall, but it began to consolidate at 30, and we easily collected all the money that we possibly could get on this position. Even though at the time that I announced the position, I told people who subscribe to the newsletter that the position is likely to be challenged. I did not think it would drop below the 25 level based upon the more complex technical analysis, and it never really challenged it. It closed right around 30. Another position was Alcoa. Now, Alcoa was just, I mean, these are the kind of positions you've got to find, and they're very hard. They take work, and what I'm going to do is I'm going to show you how to find them. Now, the position was placed here. Alcoa was in an uptrend. All we had to do at options expiration, which was December 16th, was have Alcoa expire above 8. And you can see Alcoa challenged us. It went down to 780, but it just jumped right back up. And right now, Alcoa is at $10.12. So this is one that dropped below. We stuck it out, and it shot right past at the time of expiration. Alcoa was an easy position. Now, the other one that I picked was Chicago Bridge and Iron. And Chicago Bridge and Iron actually gapped up right after I placed the position. And we only needed 40. And it gapped all the way up to 45. And you can see that even though it then retraced a little bit, we never had a problem with Chicago Bridge and Iron. CBI was a huge winner for us. It returned 100% of our potential net profit. Now, I just want to give you a couple of other, I didn't make charts for them, but we took a position on Apple, 100% of our potential profit returned. We took a position on Expedia, 100% of our net profit returned. We took a position on Tyson, which is the food company. Now, Tyson was interesting because right after we took the position, the World Health Organization came out with a study that said that if you eat processed meat, you have an enhanced likelihood of getting colon cancer. And Tyson got beaten down. But then a number of studies came out that said that the percentage, the increased or enhanced risk was very minimal, and that if you didn't eat processed meat, you would die of starvation, and Tyson just flew. So we did great on Tyson. Now, I should have put up, I didn't have time, but I'm going to show it to you in real time. So I'm going to take the charts off. I'm actually going to show you the actual positions. So just hang on 1 second, and I'm going to move to our live charts. Hang on 1 sec. Okay, now this is actually our stock trading platform, and these are our new stock quant lines. Now, what I'm going to do is I'm going to put in this is the only position that we've taken in 2 months that has caused us distress. It's Walt Disney. Now, Disney will load in a second. Here we go. Now, we don't have the background bias, but it's really not important. what I'm going to do is I want to go back. Where is Disney trading right now? It's trading at 105.39. It was as high as 105.90 today. And you can see it's sort of trending sideways today. Made a run up. But I'm going to show you what happened with Disney. Now, these are the kind of things that happen. And Disney was our only clear-cut loser. Now, here is Friday. The date on here is 12/18, and I believe Friday is the 18th. Let me just check that. Yep, Friday was the 18th. So the stock opened, and then this was options expiration day. All we needed was the stock to close at 110, and the stock was at 112.40 at 9:35. And then somebody came out with a sell recommendation on options expiration day, and watch what happened to Disney. Now remember, 110 is our number. Now we're at 109. So it dropped it all the way from 112 to 109 on options expiration day. And it's going to go lower, I think. There's 108. So we're well below, all out of the blue, we're well below, and you can see our quant lines. And these are brand new. And they're very, very specific. Not sensitive, but specific for telling you when the market's going to go down. These are our stocks, and this one, and actually, this is our Nasdaq line. We would have to move Disney to our S&P 500 line, but anyway, the point being that Disney got beaten down on the last day of options expiration. And this is the only loss that we have ever taken in the portfolio. Now, we did take two other losses because of me, actually. American Eagle Outfitters just fell below. I closed the position early at options expiration. It was well above our price for 100%. The other one was Cheniere, ticker's LNG. And I can tell you right now, we took the position because Carl Icahn took over 12% of the company. Cheniere is a natural gas in a very bad industry. But when Carl Icahn speaks, people listen. And Cheniere really flew on that news. So I closed Cheniere a little bit early. It wound up closing above 40, would have given us 100%. But we took a small loss on Cheniere and a small loss on American Eagle Outfitters because I jumped the gun. But I'm conservative that way. Every one of our other positions has given us 100%, except for Disney, which we did take a loss on because of that downgrade on the last day of options expiration. This would have happened a week earlier. We could have managed the position, minimized the loss, and waited for Disney to eventually come back to us. If it didn't come back, we would have a managed position, and we would have only had a small loss. But it's sort of like the company declaring bankruptcy on options expiration day. It's something that you just can't manage. Now, let me just show you one or two others here. Let me show you Expedia. I'll take a minute to load. This is the last chart I'm going to show you, and then I'm going to go into I'm going to go into some details about our strategy. Now, I've been to 100 seminars, webinars on options. Um, Very rarely do people go back into their own portfolios, review their own picks, look at other picks from other portfolios, which you are free to review. There's nothing proprietary about an expired position that was recommended way back. You're not giving away any proprietary information. No one's saying that this is a position for you to take today. Just let's wait for Expedia to load. It'll take a minute or two. Now, Expedia was another really, really nice winner. Now, the technical analysis of this technique is a little bit more complicated, but it works great. And here's Expedia. Now, you can see Expedia right now is moving sideways. And let's go all the way back. Okay, hold on 1 second here. I just want to get the specifics on it. Expedia, you can see, is a terrific stock. Now, I just want to find the expiration day. 12/16. Now, 12/16, we needed Expedia to expire above 110. I'm sorry, the 20th was options expiration. Here's the 15th. Go very quick. Let me just move this fast. 17. Right here. And you can see Expedia is expiring right around 126, $16 higher than what we needed for Expedia in order for us to recover 100% of our potential profit. So Expedia was just sort of the kind of position you just sit back and wait for options expiration, and you really can say to yourself, I'm going to collect 100%, even though it's not credited to you until the time that the option expires. So let me just put this back, and we'll go back to the slides. Now, it's taken me a long time to work this out, and it takes me a lot of work every night to find these positions. I've got to do a lot of technical analysis, and I've got to do a lot of fundamental analysis. The technical analysis is hard. The fundamental analysis is also a little bit laborious. Now, I have ways that I can show you to streamline it, but it's still not an easy endeavor. Now, let me go back to the slides, and let me shoot the full screen. Hold on 1 second. Okay, let me scroll down. Now, here is really what the deal is. I am going to show you how to take these picks. The course is 3 hours, and it's $249. Now, trust me when I tell you, as a one-time $249 payment, the likelihood of you making that back on your first position is extraordinarily high. Extraordinarily high. And for the first 5 people only who buy the course, now we'll set the date for the course. It's probably going to be right after the holiday because I want everyone to have a maximal opportunity. That's why I didn't put in a date. You're going to so you get the you're going to get the webinar, and you're going to get 1 month of the options newsletter where I do all of the work. And or you can just get the options newsletter for $59 a month, where I do everything. But if you want to learn how to choose these positions, all of the thought process and all of the mechanics, all of the technical and fundamental analysis, I can promise you it's a technique you have never seen before. Now, it's a spread. It is not a complex spread position. Complex spreads, I think, are a disaster because there's a bid and ask on each end of the spread. But this is really a unique type of spread in terms of how we place it, why we place it, and all the nuts and bolts that go into choosing it. And I'm just going to show you one more pick. We're going to send out an email with this. If you want it, you can give us a call, and we can. Our number is 1-855-765-6681. And I really believe, with all my heart, that you will make this 249 back easily on your first pick. Now let me go back to the charts. I think I'm going to need Leo for that. So hold on 1 second. All right, now I'm going to show you a working position that we have right now. We just placed it, I believe, 48 hours ago. And could it be a loser? Yes. Was it hard to find? Yes. Do I believe that the likelihood of it being successful to be 95% or greater? Yes. Let's take a look at Amazon. Because that's the position I placed and recommended to the subscribers to place. I'm going to give you a pick. Well, I'm not going to give you the pick. I'm just going to give you the instrument. It'll only take a minute for it to load. I think Amazon's down a little bit today. We have quite a few positions working in the portfolio that are doing extremely well. We have a call position on Disney, which I am a little concerned about. It's not a complex position. It is simply a 110 call that we may have to abandon a little bit early. Just wait 1 second. sorry it's taking so long here. Just give it 1 sec. I'm going to show you a live position. All right, here it comes. All right, still loading. I'm sorry it's taking so long. I wanted to show you these positions live. I just didn't want to take a JPEG and show it to you. And we're not loading a lot of data. I'm only going 10 days back. Now, while we're waiting, if you do day trade stocks and we are opening our stock trading room with our quant lines. We opened it, and we had a single quant. We wanted to go to a triple quant, 3 quant lines. We finally got it perfect. The quant lines are excellent. Provide us with a lot more predictive value on taking a trade. So right after the first of the year, our stock trading will be open. Right now we're working with someone who I'm hoping will take over the stock room, and we're going to be moving it to the morning, which is going to give you 2 trading rooms. You can have both of them open. And options are a great additional way to augment your portfolio. It's a leveraged position, and on a spread, there's a limited amount of money you can lose, just like on a call or a put. And we do create call and put positions. Just most of our positions are the other technique. It's a much safer call, and what we're looking for is capital preservation. I mean, we want to try to generate 15% plus in your portfolio a month off of this technique, and really the percentage that you generate is really how much money you commit. Not still thinking. I don't know why it's taking so long. All right, I think it's frozen. All right, Leo's telling me we have to wait for it, so just hang on 1 second. I'm sorry about this. All right, well, we're going out with a bang here. I don't know why this froze on Google. I'm sorry, on Amazon. I think we're frozen, Leo. All right, if you hang in there 1 second, I'll show you our Amazon position, and because it's a really remarkable position. These are these are positions you don't find often. At least other people don't find them often. We do. All right, we're reloading. It'll only take a minute. And what I'll do is I'll just reload 2 days of data on Amazon. And thanks for hanging in there. Again, we'll be sending you a link if you'd like to attend the webinar. If you're one of the first 5, you will get an options newsletter a month for free, or you can subscribe to the newsletter. If our track record so far is any indication of how you're going to do, you're going to do quite well. Okay, just hang in there for 1 second. We'll be up and running. Now, as I mentioned, the components of the system are proprietary in the sense that nobody else uses them. And I think part of the reason is it takes a lot of, it's like putting a puzzle together. And a lot of people are not willing to do the work that's required. Although once you have the system down, it doesn't take you that long to find them. Every now and then, though, and I'm going to show you one that I think is just really an amazing position. You get a position like this and the opportunity to make a huge amount of money. Okay, now here's Amazon. Now, Amazon, just open it up. This is at 8 range. So Amazon opened the day at 662. It's still at 662. It's just at 662.18. Now, the potential profit on this position is enormous. It's the biggest potential profit I have ever seen since I started looking at this technique. And in order for us to have any problems with Amazon, it must fall all the way to 600. It must fall 62 points for us not to receive 100% of an enormous potential return on this investment that we have. It is just a rare opportunity. I have never seen a position like this before, and I had to call and verify it. It was so big. I mean, this is going to make us an enormous amount of money. I'll show you one other position we have, since this is going to load so quick. Delta Airlines. Now, Delta has made a nice move up. It's consolidating. It's down a few cents today. It's got to fall all the way to 40 to challenge us. I mean, it's just got to make such a big run to the downside. It's almost impossible. So these are 2 of our active positions. You just have to find them. And I can show you exactly what you need to do in order to get them, and in order to place them, how to calculate your return on investment, your potential net profit and your potential net loss, all the margin requirements. We're going to go over everything in the webinar, and you're going to come away with a perception on how to place options trades that I can promise you've never had before. And this is not the way the gurus do it. I showed you the way they do it. Their analysis is really rudimentary. Their suppositions are give or take. I mean, they do look at the delta. They look at implied volatility. They look at the Greeks, and they are very important. I'm going to show you how to look at open interest. You want to have liquidity on the position. These are very, very simple things to do. And if you spend 2 hours a week, maybe 3 hours a week, you can find these positions on your own. If not, I'll do them for you. So listen, everyone. Let me just take a look and see if there are any questions, and then we'll end. Hang on 1 second. One sec. I just have to split it off here. Okay, now I have very few questions. Hold on a second. All right, let me look at the ones I have. Okay. No, there's no 15%, Chris. Nothing special. I, you know something? I can show you our track record if you email me. I, I, I can tell you the track record right now, and I can show it to you. The thing is, I don't really want to show you the positions that we have taken, but on, on this specific system, we've taken 12 positions. We've had 9 winners. And we would have had 11 winners if I would have let the calls play out. We took 2 small losses on 2 positions. We had full winners on 9. And the only position that really actually provided us with a problem with Disney was the one that I showed you where the analyst gave it a downgrade the day of options expiration. I really found that to be really a disgrace. He gave it a sell at a $90 target, and Disney was down from a 52-week high of 125, already down to 112.50 and rising strong on the anticipated sales from the new Star Wars movie, which have just been incredible. And he just bashed it. And that's the only position we really have had any trouble with. We lost a little bit of money on Cheniere because I closed it too quickly, and a little bit of money on American Eagle Outfitters also because I closed it too quickly. If all of them played out, we would have had 11 winners and 1 loser. That's our track record. Sylvain, I open a lot of positions. I just got to tell you. I really do. I mean, this technique, well, the option seminar that you have to buy, I can't record. What we do in the portfolio is we open between 4 and 5 a month. So you're going to have the opportunity to make 4 or 5 purchases of 4 or 5 different options. And the one thing that I'm very careful of doing is I try to open each position in a different industry. Like we have an airline stock, we have which is Delta, we have a tech stock, which is Amazon. I'm looking at a retailer. I haven't made the recommendation yet. It might be Tiffany's. It might be Estee Lauder. I'm looking at to see which one's going to return us more money. So I still haven't made a commitment on that yet. And then I'm going to look at a fourth position. Now we already have about 7 active positions in the portfolio, but I want to add 2 more. And I just look for different sectors of the market. So if one has a problem, like commodities, or the techs, or the home builders, or the retailers, we're only going to have a problem with one position. We're not going to have a problem with the portfolio. And remember, a lot of what happens in the market is sector rotation. When one sector falls out of favor, one sector comes into favor. There's a lot of times when there's a generalized sell-off and everything gets hit. But one sector, but certain sectors will always fall the smallest. We're looking to place our positions in those sectors with the best relative strength, and we always try to diversify so that each of our picks are in different sectors. And that's really, really important. Now, I put a lot of positions on each one because I've done I've just made really wonderful money off of this. Yes, for the 249, Chris, we tell you everything. I mean, we're going to show you how to pick the month, the strike month, and the strike price. In fact, that is the key. That is the key metric that you need to decide. And I'm going to give you an abbreviated way where you can look quickly on a stock. First of all, I'm going to show you how to find the stock quickly. It is not easy if you don't understand how I do it. And I'm not trying to tell you I have all the answers, but I have a lot of them when it comes to trading options now. And you're gonna have a small basket of stocks that you're going to look at, and then I'm going to show you quickly how to look at which strike price. Strike price is actually, because this is a spread, to choose, and it's not going to be hard for you. Rich, on some of them, I take a 30-day strike. I go 30 days out. On some, I go 60 days out. I never go 90 days out. The furthest I'm willing to go out is 60. So right now in the portfolio, we have positions that expire in January and positions that expire in February. That's as far out as we're going to go. The track record, Chris, is since I started it. It goes back about 4 months. And based upon where we are this month, we should have a really, really stellar January. And February, when I believe that Amazon isn't going to challenge that $600 price. I believe, if anything, we're going to wind up going higher on Amazon. We're going to receive the biggest potential profit we have ever gotten off that Amazon position. And I have a huge amount of Amazon positions. If, listen, lightning could strike and something really terrible could happen to Amazon, but I just can't think of what. If it consolidates, no problem. If it slowly drifts down, no problem. We got 60 points on Amazon. I put in about 4 a month, Paul. Now, when I first started it, I had like 6 or 7, and I got complaints that I was placing too many positions, and people didn't have the money to put us, So what I'm looking for is in the portfolio to always have initially 4 with a 30-day strike and 4 with a 60-day strike. Now, obviously, the 60-day strike is going to give us more money than the 30, but now we're constantly turning it over. When we move a month, that the 60 become 30. and we're going to add new positions, and we're going to add 4 more with a 60 strike. 8, Sylvain, about 8. Sometimes it's hot more, sometimes 10. See, the thing is, sometimes in the middle of the month, with 45 days out, I'll just see a tremendously uh, advantageous position. So I'll put it in, and it'll be a 60, it will be 45 days out, but we're not going to go more than 60. It's the initial strike. We've already had 2 weeks down on it. So instead of having 2 months to have to watch it, we're only going to have 45 days. But I'm always looking for new positions that meet our parameters. We have to have a certain amount of potential return. We have to have a limited amount of losses, which I'm going to show you in the webinar. And the position has to be exceedingly safe. It has to give us a tremendous margin, or else we're not placing the trade. And one more thing, there's got to be a tremendous impetus for the stock to rise. And I'll give you away a little bit of what I do, because a lot of people have hung in to the end of this. What I do is I look, and it's very simple, and I can show you where to find it. I look for insider buying. And I just don't mean small insider buying. I look for huge purchases of insider stock or an enormous number of calls placed on a position with a given strike. I mean, that's institutional money being put to work. And I've had a couple of positions that I haven't mentioned that I didn't even put in the portfolio. One was Geron, Geron. The ticker was GERN, Gern. It was a small biotech. And I didn't want to put it into the portfolio because I just felt a little insecure about it, and I only want the best positions in there. But it was a position I took myself because there was a constant insider purchase by the owner of the company. Constant. 20,000, 30,000, 50,000 shares. He just kept beating it and beating it and beating it. So I bought Geron. The technicals were good. It was consolidating off of a low, and it had a $4 strike, and I wound up selling it at $5. I made about 60 to 75% on the position. And it was because I looked at the appropriate impetus for that stock to go up. And it really is institutional money flow, or the chief financial officer or the CEO making huge purchases optimally, where they just keep hitting it and hitting it and hitting it. Those stocks are, along with the technical analysis, are better than any thesis that more money is going to go into a tanker and the tanker stock is going to go up, or the yuan was devalued, so American Eagle Outfitters is going to fly. If that was the case, you know what you would be seeing? You'd be seeing insiders moving into it. You'd be seeing the CEO, the CFO. You would be seeing them purchasing stock. If the thesis was correct, you'd be seeing people taking huge call positions, 20,000 calls, 30,000 calls. When you don't see that, when no one's reacting to your thesis, there isn't great money flow into the position, then it's more than likely the thesis is not going to play out. So we reverse it out. I look at the huge money flow first and then back out and see if I can find a reason why. Now, sometimes it's really obvious, so that the thesis that's right in front of your nose is correct. But we now have objective evidence that not only do us as the small-time trader believe it to be true, but the insiders with the big money are moving in. And that's what's happening with Amazon. There's tremendous call buying activity on Amazon. I mean, it's huge. That's what first had me look at Amazon. And then when I looked at the potential profit, my eyeballs popped out because I knew what the right strike price was. I knew what the right strike month was. But what put it on the radar for me was the fact that there's just an immense amount of new call buying activity on Amazon. So there's a lot of people with big money, most likely institutional traders or billionaires, who believe that Amazon is going to hit a strike, and I know what the strike is. So it's so far above where we are, we're very likely going to hit it. And I'm going to show you exactly how to find, because what we want to do is we always want to follow the money. It's really nice to have, something in your head like, well, the yuan's devalued, et cetera, et cetera. You were going into Christmas season, and all the kids are going to be going to the store, and they're going to be buying going to American Eagle Outfitters, or look at the thesis on Gopro. GoPro is the number one in their industry. And boy, GoPro was 75. But did it get mauled? And it got crushed. And there was no money flow into GoPro. When we took the GoPro position, it was when money started to flow. There was huge insider buying. And the fact was, the insider buying was wrong. They were buying, there were call positions placed, and the call positions were all placed between 30 and 35, and that was our downside level. All these people had to have the stock. Those were the strike price. So that was a safe level with which to place the position. Now the stock is well below. The insiders are not always correct in the long term, but they were right in the short term for us. And we had a walk in the park on GoPro, even though GoPro later on was to collapse. That's why I bought Alcoa. There was enormous amount of people buying Alcoa, and Alcoa challenged us. Now Alcoa is up to 10. So, and these are people. A lot of these institutions, a lot of these are hedge funds. A lot of these are mutual fund purchases, because they're enormous purchases. They're multi-million-dollar purchases of the stock. We don't want to see 1,000 shares or 10,000 shares. We want to see 100,000 shares purchased, or of 250,000 shares purchased. Then we know that there's institutional money out there that believes that this position is going to rise. And then we just have to look for a very lucrative metric in terms of a return on investment and a cushion to provide us with to ride the trade through, because they're not always exactly correct, and the stock may bounce around. If we had the money to buy Alcoa on a long-term basis, at the time, Alcoa was at about $8.50. Now it's heading towards 11. You're up an enormous amount of money if you could buy 50,000 shares of Alcoa. We can't do it, but that's the nature of what we're going to be doing and what I'm going to be showing you how to do. And I'll just tell you this, for the people that are still in the room, we've still got most of the attendees. It's going to be applicable to you even for stocks, to buying the stocks itself. And it's also going to help you if you swing trade stocks, which is essentially what we're doing here. I mean, we're swing trading a stock, a 30, 45, or 60-day stock, because really it's the underlying instrument that provides us with the money on our option. And, we're looking just to swing trade based upon the underlyings. But the other thing is we have to look at the technicals. If the technicals are really awful, money flow is going to be important, but it may play out too late for us. I don't want to go out more than 60 days. And it may take 120 days or even 150 days for that stock to rise. Because remember, these are long-term players. The CEO is not buying 100,000 shares of Alcoa because he believes it may go up in 30 or 60 days. Maybe it'll go up further out and we're going to get burned. So we have to look at the technicals. The stock has to be in a reasonable spot for us. So when these all come together, and I can show you how to do it, it is not hard. and I can show you how to find this information. It's really super easy. Then it really provides us with a nice cushion to create 8 or 9 positions in the portfolio that have a tremendous ability to yield us 100% of our potential net profit. And let me just I like TD Ameritrade. I've been using them for years, Chris. Hey, listen, if we're in a market crash, this is the best kind of position to be in because we're giving the stock, the underlying stock, a large window. Now, the thing is, there's always the potential for a crash. I mean, there could be some major holocaust that takes place. We live in a very dangerous world. And all I can say is never invest more than you can afford to lose. I mean, I can just give you a quick anecdote, but I used to trade a lot of forex pairs, and I had a lot of European currencies short during the World Trade Center, and the actual World Trade Center, the airplanes flew into the World Trade Center and destroyed the forex exchange. So the whole thing was down for about 4 days. And when it opened, all the European currencies that I had short went up an enormous amount, and it cost me a gigantic amount of money. So catastrophes like that happen, but barring some catastrophic event, and you not placing too much money out there, these positions are very solid. Larry, I produce exact everything. I give you limit orders on every purchase and limit orders on every sell. I don't just throw it out there. Let me see if I can find it here. Let me see on the newsletter. I'll give you a typical the way it is done. Now I have a position I put in on Fitbit. I really like it, and what I did was blah blah blah, but the net credit is a limit order, and the limit order is 33 cents. So it's an exact purchase. Now Fitbit has to drop 13% in order for us to have any problems with that stock. And I think the likelihood, and that's only a 30-day position. Well, we've already been trading it for 3 days. We only have we have about 26 or 25 trading days. I think Fitbit's going to yield us 100%, and it was a very, very juicy premium. So I give you all the exact entries. You place them the night before as a limit order, good till canceled, or unless I cancel it. You don't have to think about it. Return on investment, Chris, must be at least 15%. The return on investment on Amazon was close to 30%, which is a gigantic return in the kind of positions that we're placing. Remember, we're giving ourselves a huge downside. I mean, Amazon can fall 60 points, and we're still going to make 100%. So we're looking at a 30% return on investment, which is really big. They are not straight calls. They are not calendars. They are spreads, vertical spreads. A great broker, again, is TD Ameritrade. No, they are not open to the downside, Sebastian. Absolutely not. Every spread has a limit to the upside and a limit to the downside. And when I put the position in, I give you the potential return to the upside, and I always give you the potential risk to the downside. And I mean, that's the point of placing a spread over a naked position. Um, well, listen, the naked position is easy, but we're not selling a naked put or selling a naked call. So we definitely are going to have a limited uh, downside loss. And what I do is I tell you how to calculate the exact price that the stock has to close at to give you 100%. Because depending upon the size of the net credit, we get more and more leeway to the downside. That's why we look for large returns on our investment. I mean, although I say Amazon has to close at 600, we really have even more because we got a 30% return on investment, and we've got to lose that 30%, which gives us even more of a downside on Amazon than Amazon all the way down to 600. Sebastian, it's based on us not touching it, without touching it. Now, on the loss side, um, and you're asking really, really good questions. I just want everyone to know. On the loss side, if you don't touch the position, our goal is simply to have the position expire, have both legs expire worthless. We keep 100% of our profit. If the position has to be closed, it's because there's a problem with it. Now, we couldn't do anything about Disney because Disney occurred the last day before the day of options expiration. And there were only two positions that I told our subscriber to close, American Eagle Outfitters and Chenier. They were closed with a very small profit, very small loss. And if I just had sat on my hands, they both would have gone on to be 100% winners. And I can tell you right now, one of the benefits of this option strategy is we're looking for expiration to take out our trades, and so we save 50% of our commissions. If we buy a put, we're charged when we buy it, and we're charged when we sell it. If we buy a different kind of position, we're charged when we open it, and we're charged when we close it. On this position, we are not charged, and so we save a lot of money in the commissions because 9 out of 12 positions have expired worthless. We don't do anything, and we're out of it. So that's one big benefit. There are many, many other benefits I'm going to go over with you in the options in the webinar, and they involve dividends. They involve a whole bunch of things that people do not take into account. But I'll just tell you, if you're a major options trader and you're holding a big call position and there's a large dividend disbursement while you're holding the position, you're going to wind up with a real bruise on the butt because you have to pay for that. So we walk around that with this position. We don't have to worry about the disbursement of dividends. And there are many, many other really major upsides to this strategy. So I'm going to cut it off because I've been going a long time, almost 90 minutes. If you just want to take a peek at it and subscribe for a month, it's only $59. I think you're going to make great money if you want to learn how to do it and get a month free for the first 5 people. We had a nice amount of people in the webinar. We'll put you in the room. There's no. I'm sorry. I'm so used to the live trading room. We'll start you with the next options newsletter. It's going to show you all of our old positions. It's going to show you our active positions, and active positions are always updated as to how much they're making or losing, and it's also going to show you the new trades. So that's it. If you have any more questions, just give us a call. I really wish everyone a happy holiday. Christmas is coming up, and I wish everyone really the best. Whether you celebrate it or you're not, it's a really nice time, and I wish everyone a lot of health, happiness, and success. So if you have any questions, just give us a call and we'll be happy to answer them. So have a great, great afternoon. Bye-bye.